Global trade policies have taken center stage for investors, overshadowing the market's previous favorite topic, AI, and causing significant market uncertainty. Now that uncertainty isn't going away, and tariffs remain a key risk for the coming months. But following the announcements of some trade deals, there seems to be a degree of calmness in the markets. So the key for investors will be mitigating risks through diversification, while actively managing assets to capture arising opportunities. And on that note, here are our 4 investment themes for this quarter. Although tariff and inflation concerns will keep US equities volatile in the near term, recent earnings data provide a sign of resilience for 2025 and project an improved outlook for 2026. We think it's a good time to add back to US equities, but diversification elsewhere is also essential. As investors seek higher returns, capital is likely to flow towards Asia, where solid structural growth and supply chain realignment should mitigate tariff impacts and present attractive opportunities. We favor equities in China, Singapore, and India, especially companies with a domestic focus. The UAE also offers structural opportunities and is less challenged by tariff stresses. With the focus on tariffs and other headwinds, it's easy to lose sight of long-term structural trends and innovation. After the sell-off earlier this year, valuations of some tech stocks beyond the Magnificent Seven look more attractive. This, together with onshoring of jobs and reindustrialization, is expected to drive sector-wide growth in 2025. We favor large-cap quality stocks in financials, industrials, and communications, and have recently upgraded US technology back to overweight. In Europe, defense and automation boosts R&D and industrial activity, and we are therefore overweight on industrials, financials, and healthcare. And in Asia, we overweight communications, as that sector is particularly receptive to AI developments, along with consumer discretionary, financials, and industrials. Mitigating downside risks involves more than growth concerns. Currency risk is also crucial. Now, the busy news flow will probably continue to lead to many ups and downs in currencies, which can affect the returns of your investments. So a multi-asset strategy that diversifies exposure across markets, currencies, and asset classes is vital. An active, selective portfolio approach ensures that managers can react swiftly to changes and capture emerging opportunities. And that applies to bonds as well. Interest rate cuts by major central banks signal good prospects for bond performance. And we particularly like UK sovereign bonds with 7 to 10 years duration and European investment-grade corporate bonds. When volatility is high, diversification should go further. Less correlated assets play a key role here. So we're bullish on gold, even from the current high price, as gold has a proven track record of hedging against uncertainty. There are numerous ways to gain exposure, such as ETFs. More countries are prioritizing physical and digital infrastructure investments for urbanization and security. And those areas offer relatively stable cash flows. There are also ample opportunities emerging due to the energy-intensive AI boom and the pressing need for sustainable electricity sources, as well as government's priorities on energy security and independence. Remember, rapid change and innovation continue to present numerous opportunities. Diversification is key for seizing all these opportunities whilst navigating uncertainties. As always, our team is here to help you tailor your portfolio to your goals.